Welcome to week 19 of our 50-week journey through life insurance optimization. I'm Jeff Cait with Math.Logic.Wealth, a collaborative community of insurance professionals working to put client choice and perspective at the center of life insurance purchase decisions. Last week, we explored traditional needs analysis. This week, we're looking for a logical next step that bridges the gap between needs calculations and product selection. We call it the allocation method. Math.Logic.Wealth is simple. We provide consumers with information they need to make informed life insurance product decisions. We put it in writing. We share it broadly. Nobody has to agree with our generally accepted life insurance principles, acronym GALLOP. But if you disagree, if you're an advisor and you don't like or agree with what we're saying, please tell us why and show us your approach. That's how we all get better at serving consumers. Let's address the real challenge we face as advisors. Traditional needs analysis can easily show our clients the cost of term insurance to meet the calculated need. Simple. But what happens next? The elephant in the room is the cost differential between term and permanent life insurance, and helping clients decide whether any portion of their wealth should be allocated to permanent coverage. After 40 years in this industry, we know how difficult it is to provide objective advice when presenting million-dollar permanent policies with complex illustrations. Commission structures mean permanent insurance pays us many times more than term. That's just reality. So how do we help clients make informed allocation decisions when our own compensation varies so dramatically between products? This chart broadly generalizes wealth allocation into these three buckets. Bucket one, registered investments, your RSPs, TFSAs, etc. Bucket two, non-registered investments, everything else. And bucket three, exempt life insurance, the permanent insurance option. Now, I've simplified the first two buckets on purpose. The real point here is creating better context for that third bucket, the one we're responsible for, permanent life insurance, and all the other life insurance options. The question isn't really about investment types. It's about whether any bucket, particularly the permanent insurance bucket, should be empty by default. Here's what we found. It's easy to dismiss this long-term family first option. But when clients have sufficient information to make an informed decision, many choose to allocate something to it. The key is providing that information. This notation, this 0% is an option, so is 50%, is just really a gateway to a bigger question, a more challenging discussion, perhaps. Is permanent life insurance worthy of any allocation of your client's scarce financial resources? This transforms the conversation from how much life insurance do you need to should permanent insurance be part of your wealth allocation? It should be a conscious financial decision, not a default based on which advisory system the client happens to engage. Now, I realize percentages don't neutralize commission bias. Advisors still get paid based on the dollar amount allocated, but framing it as an allocation choice rather than a needs calculation at least makes the decision more transparent and deliberate. Here's something logical. The most important decision in financial matters is whether to do it yourself or delegate to the best professional you can afford to engage. For life insurance optimization, this means using specialists for each bucket. When one advisor handles all three buckets, optimization suffers. Each bucket has unique tax implications, regulatory requirements, and optimization strategies. Generalists, by definition, cannot maximize all three simultaneously. This isn't about protecting turf. It's about getting the best possible outcome for each allocation decision. Math.Logic.Wealth shares these approaches because we want to put in writing information that we hope will help consumers think about the life insurance bucket and their options. As we move forward into the next few sessions of the optimal life insurance section of our Math.Logic.Wealth curriculum, we'll be introducing mathematical frameworks that make bias more visible and decisions more logical. The allocation method is one tool in that toolkit. It's not perfect, but it's more logical than the next step I have seen as a follow-up to traditional needs analysis. Math.Logic.Wealth website and YouTube channel links are available. You can take a look at our stuff. We believe better math and logic leads to better outcomes for consumers. So next week, diversification strategies within the life insurance bucket itself. Remember, we can make decisions more consumer driven by sharing the important information they need to make informed decisions about the life insurance bucket. And that's progress. Thank you.